All right, today we're tackling one of the biggest financial decisions you'll ever make, especially if you're trying to navigate the wild BC housing market. We're talking about choosing between a fixed and a variable mortgage. And listen, I'm not exaggerating when I say this choice can literally shape your financial life for years to come. If you get it right, you could save thousands upon thousands of dollars. But if you misunderstand the trade-offs, well, it could cause a whole lot of stress. I mean, think about it. With the average home price in Greater Vancouver hovering just under $1 million, even a tiny fraction of a percent on your interest rate has a massive impact. We're talking about a huge difference in your monthly budget and the total cost of your home. The stakes, they are incredibly high. Okay, so let's dive right into this million-dollar question. To really get a handle on this choice, we first need to understand the economic world that BC homebuyers are living in right now. We've just come off this absolute roller coaster of aggressive rate hikes all through 2022 and 2023. But now it looks like the Bank of Canada is shifting gears and rates are starting to come down. This makes the whole fixed versus variable decision more complicated and more urgent than ever. So what are your options, really? So at its heart, this decision really comes down to two very different paths you can take for your mortgage journey. Let's break down exactly what each one means. Okay, first up, the fixed rate mortgage. And the name says it all, right? The key word here is fixed. Your interest rate is totally set in stone for your entire term, which is usually 5 years. It doesn't matter what the economy does, your payment stays exactly the same. It is all about stability. And then you've got the other side of the coin, the variable rate mortgage. This path is, well, it's dynamic. Your interest rate is directly tied to your lender's prime rate, which basically just follows whatever the Bank of Canada decides to do. And that means your payments can change. Okay, so let's really put these two head to head. With a fixed rate, you get complete and total payment certainty. Your rate is locked in, and it's like a shield. You're protected from any Bank of Canada rate changes during your term. A variable rate, on the other hand, is directly plugged into the bank's decisions. When they cut rates, your payments go down. But when they raise rates, your payments go up. And that right there, that's the fundamental trade-off at the heart of this entire decision. It's a classic battle, stability versus potential savings. Are you willing to maybe pay a little extra for peace of mind? Or are you willing to ride the waves a bit for a shot at some serious savings? So, you might be wondering, what does history tell us? Well, if you look at the long-term data, it's pretty surprising. Historically, variable rate mortgages have actually saved homeowners money, a staggering 88% of the time. That is a powerful statistic, and honestly, it's why so many people have chosen variable over the years. But, and believe me, this is a huge but, what happened in the past doesn't guarantee what's going to happen next. Anyone who had a variable rate mortgage in 2022 and 2023 felt the risk in a very, very real way. We went from rock bottom historic lows to a peak of 5% in about a year and a half. For a lot of people, it was a stressful, expensive lesson in what variable can really mean. So here's what this all boils down to. Trying to outsmart the market, trying to perfectly predict what the Bank of Canada is going to do next, it's a fool's game. The best decision isn't really about economics, it's about you. It's about your personal circumstances. And get this, here's a stat that I think blows most people's minds. A huge majority of Canadians, nearly 60%, don't actually make it to the end of their mortgage term. Life just happens, You get a new job, your family gets bigger, you decide to move, and this fact makes our next point incredibly important. Okay, so what happens if you're one of those people who needs to break your mortgage early? This is where things get really different. With a variable rate, the penalty is usually pretty simple. It's just 3 months of interest. So on a $600,000 mortgage, that's about $7,500. But with a fixed rate, it's a totally different ballgame. The penalty is often calculated using this complicated thing called the interest rate differential. Now, in simple terms, it means you have to pay the bank back for the profit they're losing because you left early. If interest rates have dropped since you signed your mortgage, that penalty can be huge. We're talking $20,000 or more in this example. That's a massive difference in flexibility. All right, so how do you figure out which path is right for you? Well, it really just comes down to answering 3 key questions, and you have to be honest with yourself. Question number 1. Think about your future. How likely is it, really, that you might move or change jobs or need to refinance in the next 5 years? If there's a good chance you'll need to make a change, that much lower penalty on a variable mortgage gives you extremely valuable flexibility. Number 2, let's talk about your budget realistically. Could you actually handle it if rates went up and your monthly payments suddenly jumped by a few $100s? If the answer is no, or if that would cause you some serious financial strain, then the certainty of a fixed rate might be worth every penny. And finally, question number 3 is all about you, your personality. Are you the kind of person who would be constantly checking rate forecasts, worrying about the next Bank of Canada announcement? Sometimes the peace of mind that lets you sleep at night, the kind that comes from a stable, fixed payment, is priceless. Whew, okay, that was a lot of ground we just covered. So let's pull it all together and give you a really clear framework to help you make your decision. Let's make this super clear. Think of it this way. If your absolute top priority is peace of mind, if you're a first-time buyer, or you're on a tight budget, or you know for a fact you're staying put for the next 5 years, then the stability of a fixed rate is probably your best bet. But if you've got some wiggle room in your budget, if you think you might move or refinance, and you're comfortable with a bit of uncertainty for the chance to save more money in the long run, then a variable rate is likely the better fit for you. At the end of the day, it all comes back to this one idea. This decision is way less about chasing the lowest possible starting rate and way more about a deep, honest understanding of your own life, your finances, and your personal comfort level with risk. So I'll leave you with this final question, the one that really gets to the heart of it all. When it comes to your home, to your finances, what do you value more? The calm predictability of knowing exactly what you'll pay every single month, or the exciting possibility of saving more over time? The answer to that, well, it will tell you everything you need to know.